Welcome to our video on investment lessons from Peter Lynch, one of the most successful investors of all time. Peter Lynch is best known for his tenure as the manager of the Fidelity Magellan Fund from 1977 to 1990, during which time he achieved an average annual return of 29.2%. This performance earned him the nickname the Wizard of Boston and cemented his place in the investment world as a true legend. In this video, we will be discussing some of the key investment lessons that we can learn from Peter Lynch and how they can be applied to our own investment strategies. From the importance of research and due diligence to the value of contrarian thinking and the power of patience and long-term investing, we will explore some of the key principles that guided Lynch's successful investment career. One of the most important lessons that we can learn from Peter Lynch is the importance of research and due diligence when it comes to investing. Lynch believed that in order to be a successful investor, you had to truly understand the companies in which you were investing. He was a firm believer in the idea that investing is not a game where the guy with the 160 IQ beats the guy with 130 IQ, but rather, it's a game where the guy who does his homework beats the guy who doesn't. Lynch was known for spending countless hours researching and studying the companies that he invested in. He would visit the company's factories, meet with management, and even talk to customers to get a sense of the company's operations and growth potential. He would also look at financial statements and other financial data that would help him understand the company's financial performance. By doing this research and due diligence, Lynch was able to identify companies that were undervalued or overlooked by the market and invest in them before they became popular. One example of Lynch's successful investments that was the result of thorough research is his investment in Hans. Lynch had visited the company's factories and was impressed with their operations and management and saw the potential for growth in their product lines. He invested in Hans when it was trading at a low price-to-earnings ratio and held on to the stock for several years. Another key lesson that we can learn from Peter Lynch is the value of contrarian thinking when it comes to investing. Lynch believed that the key to successful investing was to go against the crowd and invest in undervalued or underfollowed companies. He often looked for companies that were out of favor with the market and that had been overlooked by other investors. By doing this, Lynch was able to identify companies that had the potential for significant growth and invest in them at a lower price than what they would be worth in the future. One example of Lynch's successful investments that were contrarian in nature is his investment in Fannie Mae. In the early 80s, Fannie Mae was a government-sponsored enterprise, GSE, that was trading at a low valuation and was facing a lot of criticism from the market. Lynch saw the potential for growth in the company and invested in Fannie Mae when it was trading at a low price-to-earnings ratio. The lesson here is that by thinking contrarian and going against the crowd, we can identify opportunities that others may have overlooked. It's important to remember that the market is not always right and that there are always opportunities for growth and value in companies that are out of favor. By looking for these opportunities, we can make more informed investment decisions and potentially reap significant returns. It's important to note that contrarian thinking doesn't mean going against the market blindly, it's being able to critically evaluate the market conditions and trends and make a strategic decision. It's also important to have a clear understanding of the company, its fundamentals, and its long-term prospects. A third key lesson that we can learn from Peter Lynch is the power of patience and long-term investing. Lynch believed that one of the most important aspects of successful investing was the ability to hold on to investments for the long term. He understood that the stock market can be volatile in the short term and that many companies may not see significant growth or returns in the short term. But he also knew that over the long term, the companies that had solid fundamentals and long-term growth potential would see significant returns. One example of Lynch's successful investments that required a long-term holding period is his investment in Walmart. Lynch invested in Walmart in the 1970s when the company was still relatively small and unknown. At the time, many investors were skeptical of the company's growth potential, but Lynch believed in the company's long-term prospects and held on to the stock for several years. The lesson here is that patience and long-term investing are crucial when it comes to achieving success in the stock market. By holding on to investments for the long term, we can ride out the short-term volatility of the market and allow our investments to grow over time. It's important to remember that investing is not a get-rich-quick scheme but a long-term process that requires patience and discipline. By focusing on long-term investments, we can make more informed investment decisions and potentially reap significant returns over time. In conclusion, Peter Lynch is one of the most successful investors of all time, and his investment strategies have a lot to teach us. From the importance of research and due diligence to the value of contrarian thinking and the power of patience and long-term investing, Lynch's principles have stood the test of time and continue to be relevant today. By taking the time to research and understand the companies in which we invest, we can identify opportunities that others may have overlooked. By thinking contrarian and going against the crowd, we can identify potential growth opportunities in companies that are out of favor. And by holding on to investments for the long term, we can ride out the short-term volatility of the market and allow our investments to grow over time.